Hey guys, it's Justin Goodbread here with Financially Simple. So recently in client meetings, I've had lots of questions about, man, Justin, what is happening in the market? Now, I've done a video recently, not too long ago. I sent a private message video to all of our clients dealing with, hey, here's client information. And if you're a client, you got the information. If you're not a client, become a client. But I've sent a couple of videos out, what's happened in the stock market. And I want to highlight some things that I've noticed this year. And I'll bring it down to a couple of things that you can do right now as you're pondering this year's resolutions. And so I've got some notes here in front of me. So I'm going to be kind of looking down at my notes as I talk through these because there's some key points I want to drive home. But I want to give you some data here. So on January 4th, so that's been some 20 days ago or so, the Dow Jones Industrial Average jumped 738 points. It was the largest single day in the history of Wall Street. January 4th, 2019 was the largest single day's gain in the history of Wall Street. Well, why is that? Well, it's because the Bureau of Labor and Statistics reported that we had added over 300,000 jobs in the month of December. And it's not that we just added 312,000 jobs. That's not the big deal. It's the fact that they were only anticipating, again, the Bureau of Labor Statistics were anticipating that we were going to only add about 184,000. So instead, we almost doubled in a given month. And since that time period, Wall Street, boom, shot off. And that's what caused the Dow Jones on January the 4th to jump up 738 points. Why does that matter to you? It matters because of this. If economists are bad at making predictions, I mean, this is the Bureau of Labor and Statistics. These are supposed to be the pros, right? If they're bad at making prediction with all their data and everything, how in the world do you think that you can support and go against them? And they're wrong. So why in the world would we, us common folks, right, us lowly common folks down here in the real world, not up in some marble tower up there, why in the world would we pay any attention to what the markets do? Because at the end of the day, even the pros miss it on a regular basis. Now, what's especially interesting to me is when the Dow jumped through 738 points, it was only a day after it had fallen several hundred points. So it dropped down a couple hundred points in one day, flipped back around, went 738 points the very next day because the professionals missed the mark. Right now, you're going to start seeing a lot of people claiming they got it right. They called the market crash right way back when. Or remember whenever I called that big stock, somebody tagged me on a Facebook comment not too long ago, and they were talking about this one particular company. I'm not going to name names. They picked out the best stock. And if you just bought what they recommended before, you'd be a multi-gazillionaire. And when you clicked on it, it took you into a subscription basis for you to try to buy their subscription. Let's put a little logic here. Have you ever noticed on the channel, the TV channels, I get a kick out of it when I go out of town. We don't have cable at our house. We live in the middle of the woods and they just don't run cable. I mean, we barely have sunshine where we're at. But on the TV, these folks are always talking about buy gold, buy gold, buy gold. Gold's set to shoot up 1,000%. Friends, I got to tell you, if I knew that something's going to go up 1,000%, I probably wouldn't sell it. Think about it. Just like if these people knew the stock was really going to increase thousands of percent, why would they tell you to buy a subscription? Wouldn't they want you instead to go in and buy as much as you can versus paying them for a subscription? And buying as much as you can is going to drive the price up. Some people argue that's what happened with Bitcoin. When Bitcoin went from $3,000 per unit price to $19,000, almost $20,000, that's what people were projecting. That's what's called a pump and dump. People pump it up and they dump it. Guys, look, don't worry about the day-to-day. So many people, especially young folks, look, you're my age. I might not be young anymore, but if you're just getting started in the financial markets, don't worry about it. Place your money in a very good portfolio. Talk with your financial planner. Place your money in a good portfolio and forget about it, guys. The day-to-day will drive you batty. Look at me. I have gray hair and no hair. It'll cause you to lose sight of your long-term desires. So the other thing I want you to look at is when the market went up 738 points, that very same day, the bond market fell, boom, dramatically. So when this day that stocks were zooming in price, bonds fell. Why? In fact, let me give you this. It fell for the largest single fall in a 4-year period of time. Well, why? Well, because there's a continued fear right now that inflation is going to keep rising, thus interest rates are going to rise. And as a seesaw works, when interest rates go up, bond prices go down. And so by bond prices dropping right now because of the fear of interest rates, those of you who are concerned the market's going to fall apart tomorrow, you could be jumping out of the frying pan into the fire, as my grandma would say. You could be saying, well, look, I'm scared the stocks are going to fall, so I'm going to jump into the bonds over here. And the very bonds could end up losing value because of the rising interest rates. We already know, according to the last Federal Reserve update, that we're going to potentially see, they didn't say it for sure, but we're anticipating that we're going to see some rises in interest rates this year by the Federal Reserve. Now, I don't think they're going to be as many, my personal opinion, I could be wrong. But I don't think it's going to be as many. But however, you could be, at your concern of dealing with equities, the stock market's falling, you could be jumping from the frying pan to the fire. So what does this mean for you? What is all this data that's just been given to you? If you're fearful about stocks and you think you're going to increase your safety by going to bonds, you could be hurting yourself. That's number one. So when the stocks are going all crazy right now, keep your long vision and focus. Don't worry about the short-term immediate, especially us young folks. Don't worry about it. The second thing is, don't try to figure it out on your own. If the professionals, I'm talking about the guys who know the insider, all that information, if they can't hit it right, we already mentioned the Bureau of Labor and Statistics missed it by more than almost double, totally missed the jobs report by more than double. If they don't get it right, what makes you think that you're going to get it right? So this is where I'm going to tell you to work with a registered investment advisor, someone who can help guide you through the decisions of finance. I do on the podcast, Financially Simple. Check it out. We got a podcast out there. I just record episodes on legal issues in business. If you're a business owner, I challenge you to check out the podcast. It's a rock star stuff. We got people jumping on that all the time, getting lots of information. The other thing I want you to think about is this. You cannot rely on last year's winners. Remember, there's a rule that I say all the time, and it's, if you read on any type of stock certificate, or read it anywhere in the financial world, you're going to say that you're going to read this in some variation. It's going to say, past performance does not guarantee future results. Any assumption to the contrary is a federal offense. Some people may say past performance is not indicative of future gains. What am I getting at? If somebody is telling you to buy something based on the past, based on what this has done in the past, then you could really be missing an investment, because what happened in the past may not continue in the future. One of the best mutual funds last year was pretty amazing. It was Rockstar. But if you look at what it did in 2017, it was up like 60%. Give or take. I don't remember the exact ticker off my head. I read this in a study not too long ago. It was way up there in 2017. And then last year it lost a ton of money. So just because somebody is doing really good, or you hear a friend say, hey, my advisor is rocking it out, they're at positive 70%. If you hear that stuff, guys, past performance is not indicative of future results. In hockey, Wayne Gretzky, I just butchered that name, sorry. Anyways, what he was famously recorded saying is, I'm going to skate to where the puck is going to be. That's what the planner's trying to do. They're trying to get you to focus on where you're headed and not get bogged down in the present. So in the midst of volatility, what should you do? Because we're going into volatility this year. The markets are going to be bouncing like a basketball. I see one of my friends, Josh, on here. He's like 400 foot tall, and the guy, when he bounces, like his arms are way over my head, right? And so whenever they're bouncing a basketball, the market's going to be worse than that this year, okay? With the markets going into volatility, here's what I'm saying. Do not shift your portfolio because of external factors, okay? Just because someone says they think the market's going to drop doesn't mean to go into safety. Keep your vision in place. Keep your portfolio aligned with your long-term goals. Don't allow the media, friends, family, cousin Eddie, whoever it may be, to tell you to change your portfolio because of external factors. Don't do it. That's number one. Number two, do not time the market. Do not time the market. Do not time the market. The average of the S&P 500 has been about 8.6% return over the last 20 years. That's a rough estimate on that, if you run it down, it's like 8.6 something. But the average of the S&P has been about 8.6% annually over the last 20 years. But if you were out of the market 10 days in that 20-year period, instead of getting 8.6%, you would have earned 2.5%. Now, if you were out of the market just 10 days, you dropped your returns almost 6%, 10 days. Most people don't think about that. So instead, whenever you see the market's going way up or the market's going way down, realize that your portfolio, if it's properly done by a good planner, is built to help you reach your destination. I was traveling with one of these people on here across the country. We went to Idaho, and they like to drive very, 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 very fast, very fast. And despite them driving very, very, very fast, oftentimes we would have to go really, 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 really slow. And so the speed may have reached ungodly numbers, but at some points we were crawling like turtles. The same thing's going to happen in the portfolio. You're going to have times where the market's going to accelerate really fast, causing your portfolio to gain. And other times you may be stuck in traffic, and it's okay. We still reached our destination. We were there in plenty of time. Coming back, we were in plenty of time. We reached our destination. So just keep in mind that you're looking for a long term. The third thing I'm going to get you is don't assume that recent events are representative of long-term value. So I gave this in a client video, and I'm going to give you the same example. Recently, the market's been volatile. Today it was up and down, depending on which index you want to look at. And when the markets are up and down, sometimes 700 points like it was on January 4th, sometimes on Christmas Eve, down a ton, almost 1,000 points down on Christmas Eve. Whenever the markets are volatile, we want to sometimes take what's called recency bias. It's a bias that we're looking at what's happening today and pushing it forward to an extreme in the future. Today in East Tennessee, we had snow. I know all the milk and bread's gone. Everything's gone out of East Tennessee. Cars are in the ditches. It's pandemonium right now. We literally had looks like sugar on the ground. If I looked at Emily this morning and I said, Emily, it just snowed an inch in the last hour. Get the babies, get the goats, get the dogs, get everything. Let's get in the car. We're headed to Florida. When we get to Florida, we need to go now because it just snowed an inch in 1 hour. Therefore, by February, we're going to have 20 foot of snow. Now, you would think I'm a little crazy. But yet, when it comes to investing, people do the same thing. We see the markets fall, and we automatically go into this fear that because the markets fell super fast, that it's going to continue to fall. That's called recency bias. So don't assume that what's happening in the short term is going to continue for a long period of time. The markets as a long-term period, 3, 4, 5, 6, 7, 8, 9, 10 years, the markets as a long period of time historically has gone up. Now, again, just because it did in the past doesn't mean it's going to in the future. But if you look at the data points, I know one of the clients today said, Justin, in Tennessee, we get a little snow sometimes a year, but for the most part, some winters are really bad. We had ice over the lakes here last year. This year's been kind of mild. If you kind of average them out, you get a decent winter. It's a nice, mild winter. Same thing in the markets. If you average out the pros and the cons, you're going to get a good return. The fourth thing I'm going to get you, then I'm going to shut up, is do not trade. Do not trade too much. One of the things that we men, those of us who are men watching this video at some point in the future, we have a tendency to think we can fix things, except for me. I can't fix anything on a car. I'd always break it. But we have a tendency to fix things. And we have that tendency by God-given ability, by God-given natural direction in our life. Think about it. If we want to lose weight, what do we have to do? We have to diet and exercise. If we want to get from here to there, what do we have to do? We have to get in the car and drive, or get in a plane and fly, or get in a boat and sail, or get in a train and go on the rails, whatever it is. If we want to do something, if we want to accomplish something, we do it. The stock market is not that way. It's the opposite. If you want to accomplish something, you do nothing. It's the opposite approach. And so many times, especially young investors, they want to go in and try to fix it. And men, you're worse than women are. They got a statistic. I'm going to show a client tomorrow about that. Don't touch it. So whenever you're dealing with portfolios, especially our age guys, just throw the money in the market. Don't worry about it. It will be okay. We got babies to raise. We got chickens to raise. We got kids. We got so much to do. The market does not have to be complicated. So with that, I want to shoot this quick video with some recent statistics, some questions I've gotten to help you add a little bit of sanity to this crazy financial world. And with that, like I say every week when I do my podcast, life is hard. It is. I've heard a lot of heartache this week. A lot of heartache. Life is good. We still serve a good God. He's still on the throne. He'll take care of us. Life can be frustrating. I don't have any hair because I pull it out. I deal with some of these people on here that's watching me. They're frustrating to me. Money doesn't have to be. Let's continue to make our lives at least financially simple. Y'all go out and make it a great day. Hey, check out the podcast. Check out the blog. Y'all take care. We'll talk to you on the flip side.